Did you know two founders can raise at the exact same valuation and still end up with completely different outcomes? One founder can walk with wealth and control, the other can lose control of the company, lose economics, and sometimes even lose the company entirely. Now, the reason usually sits inside a 5 to 10 page simple document called a term sheet. If you've ever received a term sheet and you felt like you were reading a legal document in a foreign language, this masterclass is for you. Hi, my name is Rahil. I'm a chartered accountant and lawyer. I've looked at hundreds of term sheets across seed and early stage deals. In this video, I'm going to walk you through every major clause in a real term sheet and explain what it really means in plain English and try to showcase a number of scenarios with a play on numbers. Let's go. We'll use a fictional company called Zeno AI, which is raising 10 crores at a 50 crore post-money valuation. That's a 20% stake for the investor. Let's go. Now, first things first, what is a term sheet? Very simply put, a term sheet is essentially a blueprint for the investment. Now, before lawyers draft the actual agreements, that is the shareholders agreement and the share subscription agreement, both sides would typically agree on the key terms in the document. It usually covers these 6 things that you see on screen: valuation, ownership, investor rights, founder restrictions, governance, and exit economics. Now, most of the time, the term sheet is non-binding, meaning that it's not legally enforceable, but a few clauses are binding from the moment you sign it. Specifically, the confidentiality, exclusivity, governing law, and expenses. Now, we'll come back to some of these clauses later, they're important. Also, note that the term sheet becomes an important base document for your shareholders agreement and share subscription agreement, which are legally binding and enforceable in court of law. Now, every term sheet tries to cover and decide for these 4 things. First, who owns the company? Second, who will control decisions? Third, who gets paid first in an exit? And last, what happens when things go really wrong? Right? Now, keep these 4 questions in mind as we go through each clause. Everything connects back to one of them. Now, before we get into rights and clauses, let's make sure that we all understand the valuation math, because founders sometimes tend to confuse this. Pre-money valuation is what the company is worth before the investment comes in. So in our example, the pre-money valuation is 40 crores. The investor invests 10 crores. So the post-money valuation becomes 40 plus 10, that is 50 crores. Now, how much is the investor ownership? That is a simple math. That is the investment amount of 10 crores divided by the post-money valuation 50 crores, which is a simple math of 20%. Sometimes the founders often quote the pre-money or use the pre-money valuation to determine the equity stake of an investor. So sometimes they would divide 10 by 40 instead of 50. So always clarify the number that you are discussing so that everyone is on the same page. Also, most first-time founders don't appreciate the clauses and terms until it's too late. So let me say this, a founder with cleaner terms can make more money than a founder with a higher valuation but aggressive investor rights, right? So what I mean is that a founder who raises at 50 crores valuation could actually make more money than a founder who's raising at a 100 crore valuation, right? There are certain clauses that could be detrimental to you. For example, a 2x participating preference or an anti-dilution that compounds across rounds and could actually show its effect in your later years. Consent rights that are routine on paper, but they start to block certain mechanisms. So don't get blinded by the overall valuation that I'm raising at 100 or 50. Try and understand the implications of each and every term that you are signing to. Now, one of the most important clauses in the term sheet is a liquidation preference. Very simply put, liquidation preference determines who gets paid first and how much. When the company goes through an acquisition or a shutdown or a merger or any kind of liquidation event, there will be an amount that is to be distributed amongst all the shareholders, right? Think of it like a queue or a waterfall as it is called, right? So typically the banks and secured debt holders are always first. Second priority goes to investors. Now, whatever is left after paying off your banks and your investors will typically then go to the equity holders or the founders. The liquidation preference defines exactly how much the investor would collect before the founders see a single rupee. Now, this is one of the most important clauses because this is really why you're working, right? This is why you're creating a company, so that you can get paid at some stage of the company cycle. So we're going to spend some time trying to understand this through a couple of scenarios. Now, the most founder-friendly version of a liquidation preference is 1x and non-participating. Here's how it works. When there is an exit, the investor typically has two options. Option A is to take a 1x preference. This simply means that they get their invested amount back first. So they invest 10 crores, they will have right to 10 crores first. Option B is to convert their equity and take pro rata percentage of the total exit proceeds. Now they have a choice to pick either option A or option B, and they would typically pick whichever is higher. And this is critical because they cannot pick both, they can only choose one. So in a smaller exit, let's say 15 crores, the investor who put in 10 crores would typically choose option A and take the preference and get back their 10 crores immediately. So what would remain, that is 5 crores, would then go to the founders. Now in a larger exit, which is 100 crores, the conversion would give them 20% of the exit amount, which is 20 crores, which is much higher than a 10 crore preference. So they would convert in a larger exit case scenario. Non-participating simply means that they can either choose option A or option B, but no double dipping. Now let's look at another scenario. That is, the company is now sold for 30 crores. So option A over here would give them 10 crores. That is, the investors get back the 10 crores that they had invested. In option B, they would get only 6 crores. That is 20% of 30 crores. So their choice would be clear. They would go for option A, and then the remaining amount gets distributed with the founders. Now things get a bit interesting when the investor starts asking for a 2x liquidation preference. So let's look at the same deal and the same exit, right? 10 crores invested, 20% stake, the exit value is 30 crores. So in a 2x case scenario, the investor would get 20 crores and the founders would be left only with 10 crores, unlike 1x. Now think about the exit being a large exit, or let's say 100 crores. Now over here, the founders would end up getting only 64 crores instead of 80 crores because of the 2x liquidation preference. So what I'm trying to say is that always push back on anything above 1x because it could be detrimental for the founders' takeaway from the exit or acquisition. Now that we've gone through a couple of case studies and scenarios, let's try and understand the difference between participating and non-participating liquidation preference. In non-participating, the investor gets to choose an option. That is, they either take their preference or convert to equity. It's one or the other, but not both, and there is no double dipping. But in participating, they also get double dipping, which basically means that they get their preference, that is their priority, and then they also participate in the remaining proceeds of an equity holder. So let's understand this through an example again. Say the company now exits at 100 crores and the investment amount is 10 crores, the equity stake remains 20 crores, and there is 1x participating. So in 1x participating, the investor would get 10 crores for their preference, but they will also be eligible for 20% of the remaining proceeds, that is 90 crores, which would amount to 18 crores, and their total takeaway value would be 10 plus 18, that is 28 crores, and founders would be left with 72 crores. In a non-participating version, they would have to choose between option A or B, that is preference or participation in equity, and over here the investors would get 20 crores while the founders retain 80 crores, right? It may affect you later. Now, another important clause in a term sheet is anti-dilution. Anti-dilution kicks in when a future fundraising round happens at a lower valuation than the previous one. Now, this is called a down round. Now, let's take the scenario where Zeno AI raised at a 40 crore valuation. Now, 18 months later, things become tough. They have not achieved a growth or markets are tough. And a new investor wants to come in, but they would come in only at 20 crores. That's almost half the valuation. So, the original investor or the seed investor paid a price based on a 40 crore valuation, but just 18 months later the company is now valued at 20 crores and the shares are being issued at half the price. So the original investor would feel cheated. So anti-dilution would protect this and adjust the seed investors conversion price downward, effectively giving them more shares on conversion in order to compensate them for the value that got eroded because of a down round, right? So that they don't get effectively diluted in the company. That's what anti-dilution does. Now the question around anti-dilution is how much protection should be given and how aggressively does it adjust? So typically there are two options. There is a full ratchet that is very aggressive and rare in India, but this could happen if the company is not doing well or the industry is not doing well. And most investors are likely to go for a weighted average anti-dilution adjustment. Now in a full ratchet, the investor's entire stake gets repriced to a new lower price. So if the seed investor owned 10% at rupees 40 per share, the new round would come in at rupees 20 per share. Under full ratchet, the seed investor now effectively owns 20%. So all of this dilution that would come in from the founder's equity, right? Because no other investor is going to give their shares. So it is the founders that are contributing to this anti-dilution. And yes, I know it sounds brutal, but that's how it is. Now in weighted average, it takes into account both the new price and how many new shares were issued. The adjustment is usually proportional and much fairer. The seed investor's stake might adjust from 10 to 12, 13%, but not double. So your term sheet should always say broad-based weighted average anti-dilution. If an investor is asking for full ratchet, it could actually be a serious red flag. Now, every investor-backed company needs an ESOP pool to attract and retain talent. But when you create that pool, kind of matters a lot. So typically there are two options. One is pre-money and second is post-money. In pre-money, the pool is set up before the investor's stake is calculated. So if you create a 10% ESOP pool pre-money, founders would go from 90% to 80% money before the investor actually enters. So investor still stays at 10% stake only, and founders end up absorbing all the dilution. But in the post-money scenario, that is post-money ESOP creation, the pool is created after the investor stake is set. Now both the founders and investors would dilute proportionately. This may seem a bit fairer. Now in most early stage deals in India, investors will push for pre-money ESOP creation. So know what you are really agreeing to. If you're creating a 15% pool pre-money, that's a 15% coming directly from the founder's stake before the investment even started. Now up next is investor consent matters. This section lists everything you need the investor's written approval for. So it usually has these 10 to 14 items. Some of the key ones are new fundraising. You can't issue new shares without approval. Borrowing above a threshold needs sign off. Any M&A or restructuring requires consent. IP transfers need approval. Key hires and fires. This is really important, and a lot of founders are surprised. But if you are hiring someone at a CXO level or firing someone at a CXO level, then you need an investor approval. Also, your annual budget needs to be approved by the investor. This could also be one of the list items, which would basically decide your entire operating plan for that particular year. So yeah, this list may sound a bit scary. In a healthy relationship, most investors would turn around this quickly, or they may not have some of these items on the consent matters list. So review this list very carefully. Think about it from a worst case perspective. If things go bad, which of this can be used against you, right? Okay, so another interesting clause is tag along. Tag along protects the investor in a specific scenario, that is when founders want to do a secondary sale of their personal shares. Now, secondary sale basically means that the founders are selling their own shares. There is no equity infusion in the company. The incoming investors would buy out the founders but not put anything in the company itself. So let's take a scenario. Let's say a PE firm wants to buy 25% of our company Zeno AI from the founders at a 500 crore valuation. This is a secondary sale. So this basically means that 125 crores is going to the founders. Now without tag along, the investor is stuck. They can't exit alongside you or the founders. They are in a company where a PE firm and the founders both sit ahead of them and there is no liquidity. But let's say you have tag along, the investor can now require the PE firm to also buy their shares at the same price per share. So the investor is selling their 20% that they had invested alongside the founders. Now, so this is largely a fair clause, and every institutional investor will ask for it because it's only fair for them to exit along with you. Okay, right of first refusal basically means that if you are a founder and you want to sell your shares to an outside buyer, you must first offer those same shares to the existing investor at the same price. So again, let's take an example. Let's say you find a buyer willing to pay 50 crores for your 20% stake. Now, before you can sell your 20% stake, you must bring that same offer to your existing investor. They have 30 days to decide whether they want to buy at that same price or pass. Now, if they match it, they would buy it. The external buyer is then out. But if they pass and they're not interested in buying out your shares, you can sell it to that external buyer, but only at that price or higher. Now, why does this really matter to an investor? They don't want unknown third parties joining their cap table without a say. So ROFR, as it is called, gives them control to that extent. Similarly, we also have ROFO, or right of first offer. Now this kind of runs in the opposite direction. It gives founders the first opportunity to buy investor shares before the investor can go to an external buyer. The key difference, as you would have understood by now, from ROFR is that with ROFR you see a third party offer and decide whether to match it. With ROFO, it is like a blind bid before external offer exists. So ROFR is generally more favorable to the holder because you have a market reference price. ROFO requires you to make an offer without knowing what the markets would pay. So both protect against unwanted parties joining the cap table, and both are just standard clauses. So just try and understand which direction each one runs in and if any of them may affect you later. Yeah. Now, founder vesting schedule is something that a lot of founders should spend time on, and it surprises a lot of first time founders. So, your own shares in your company are subject to a vesting schedule. Now, the standard structure that we typically have at MV, that 25% vests immediately on day one. Then there is a 1 year cliff, that is no additional vesting until you hit month 12. After the cliff, as it is called, the remaining 75% would vest quarterly over 3 years. That's 12 quarterly installments of 6.25% each. Now, some of you may ask that why does this clause really exist? Now, it protects the investor and frankly your co-founders from someone taking the investment money and walking away. So let's say if a co-founder who holds 40% leaves at month 18, they've vested 25% upfront plus 2 quarters after the cliff. That's 37.5% of their stake. The remaining 62.5%, that is 25% of the company, can be bought back by the investor at face value, not market value. Right? So this is the benefit of having vesting, so that any co-founder is walking away or leaving for whatever exits, investors still have some rights, and the other remaining co-founders also have rights to ensure that there is enough stake or value at the table left. Okay, this is pretty much standard. Every investor or every institutional investor would expect this, that is information and inspection rights, because they have a right to stay informed about the business since they've invested their money in your company. Now, this typically includes monthly MIS, summary of what is happening, thing in terms of revenue, burn rate, any new clients won, any new clients lost, quarterly financials, P&L, balance sheet, cash flows. They would also want your audited accounts once the CA has signed them. And they typically would also ask for physical inspection rights, that they can visit your office, your manufacturing plant, and inspect any of your books and records and operations whenever needed. Now, this typically never happens. It rarely happens unless you've done some kind of a fraud or things have gone really bad for you. Right? So don't treat this as a burden. And in fact, it would end up building some discipline, some reporting discipline from day one. Now, conditions precedent and subsequent are equally important, because without this, the money is not going to hit your bank account. Right? So before the money hits, there's typically a checklist of things that must be complete. They are called condition precedents. Now, the standard ones are the due diligence signed off, all IP transferred to the company, ESOP pool created, founders have signed the inter se agreement, that is between co-founders, background checks are cleared, definitive documents, that is your SSA and SHA, are executed. Now, even after the money lands, there are some things that you still need to do. These are called conditions subsequent, typically required to be completed within 60 days. Think of statutory filings, compliance actions that are missing from the due diligence report, milestone reporting systems, right? So all of this also needs to be finished, and failure to finish any of these line items could call for some consequences. Now, three founder obligations that a lot of people underestimate is non-compete, non-solicit, and exclusivity. Now, when you're running a business, by the very structure of it, some of the things may go wrong, and some founders may want to exit, or you may want to shut the company altogether. So that is where three of these clauses will kick in. In non-compete, you cannot start or join a competing business. Over here, typically duration and scope are defined in the shareholders agreement. So try and negotiate the scope narrowly. Similar business should typically be defined very precisely. So don't leave it vague, or it may call for some legal scrutiny later. Now, in non-solicit, you cannot hire away any of the employees if you leave, or poach customers of the company, or pull suppliers for a competing venture. This typically applies during employment and for a period after. Now, the last one is exclusivity, and this is the one that some people tend to miss. Once you sign the term sheet, you cannot approach any other investor for a set period of days. So there is no investor shopping of sorts. right? And this clause is legally binding, even though rest of the term sheet may not be, right? So the idea of doing this was that try and understand each of the clauses that you are entering into. Don't be in a rush to raise money or say yes to an investor without understanding the impact of each of these terms, right? Try and model every scenario, run the numbers in multiple case scenarios, best case scenarios, worst case scenarios, understand downside outcomes, especially in case of liquidation preference, vesting cliffs, and what happens when default clauses tend to kick in. Third, try and negotiate economics and control. Cleaner preference structure matters. And lastly, try and get a good legal counsel. Yes, there is ChatGPT, there is Claude, there is a lot of other legal tech platforms, but a startup lawyer who has seen hundreds and thousands of term sheets for a living is worth every rupee of their fee, right? This is not a place to save money, but rather to optimize for your future liabilities. By the way, you can also check out our website malpaniventures.com. We've uploaded a draft term sheet template and a term sheet explainer under the thesis resources section. You can check it out over here. This is the draft term sheet and this is the term sheet explainer. Hope this is helpful. That's it from our end for this masterclass. I hope you guys understand the term sheet better. We are going to cover SSA and SHA in our next videos. So do follow, like, subscribe, share, and you know the drill. Until next time, peace.